This is TreppWire Week in Review for the week ending August 25th, 2023. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, U.S. stocks showed signs of breaking out of their August gloom, but persistently high Treasury yields remain a concern for U.S. investors. The markets cheered as chipmaker NVIDIA posted extremely strong earnings, and that helped drive investors' animal spirits. But disappointing results and guidance from several U.S. retailers painted a concerning picture that U.S. consumers are getting stretched. Manus, we've been very positive lately, but was the glass half full or half empty this week?
That's a great question, Haley. I would say, had you asked me about noon on Thursday, New York City time, I would say the glass was half full. The stocks were having a good week. There seemed to be a little bit more confidence building after that early August malaise. And we were starting to see some irrational exuberance appear after those NVIDIA earnings. People may recall that in May, stocks really soared over the excitement over AI. NVIDIA came out with really strong earnings last night. That seemed to really trigger what looked like an inflection point. NVIDIA itself was up about 10% early this morning. The major indexes were up, and it felt good. It felt like people were thinking, wow, things are really looking good. And then around noon today, everything turned around. It was the shortest melt up in history, as after noon about today, New York time, it was risk back off. NVIDIA gave back some of those gains and tech sold off. So as of about noon, I was really definitely in the glass half full. Now at the end of trading on Thursday, I'm a little bit more measured in that. That's on the broader economic news and on the overall U.S. status of what we saw this week. The glass was, I would say, half empty on the retail side. We saw 7 or 8 retailers sell off by more than 10% this week. Some lowered guidance. Some talked about theft, which is no longer being called theft. It's being called shrinkage, I believe. And some talked about the consumer being tapped out at this point. So we'll talk about all of that a little bit more. But I was feeling pretty good for most of the week on everything except retail, and we'll get into that over the next hour.
Shared sentiment here, man. It's like we've said for the last 6 months. There's several things you could latch onto and say the glass is half full, and there's several things that you could latch onto based on behaviors that say it's empty. And I think that's the conundrum that we've had to, kind of face as our reality over the last 6, 8, 12 months, maybe even. A couple of anecdotal macro stories this week. I saw this morning there's a lot of news around mortgage demand. So mortgage lender guaranteed rate actually laid off 800 employees. So we've talked about for the last couple of months the slowdown in refinancing and how a lot of mortgage arms have laid off folks. This is another one where it's a pretty big number, 800 employees. There's some information from CNBC that came out today that said mortgage demand for home buyers dropped to a 28-year low based on interest rates. 30-year fixed rate mortgages, 7.31% nationally. And applications for mortgages to purchase homes dropped 5% for the week. And when compared to last year's number, they're down about 30%. And the adjustable rate mortgage for applications increased 7.6%, which was the highest level in 5 months. And then there's been a lot of just talk and commentary from economists and others around what this means for the broader market. And I know we don't track this in our data, but the Airbnb cycle as well. I mean, there's so many people that bought multiple houses in different locations to try to rent them as short-term rentals. And that seems like that bubble is getting bigger and bigger, and there's potential for that to come to a head at some point. And so, I think those are things that maybe are not even on the radar this week in terms of glass half full, glass half empty, but they're just kind of hanging out there in the periphery that if and when those things start to overflow, could have some real negative implications for the broader market.
That part about the floating rate demand ticking up got my hair standing up on the back of my neck. I have to say that is a recipe for bad news. I hate to say it, because normally the benefit you get in the immediate term from a slightly lower rate for taking on floating versus 30-year fixed or 15-year fixed is so de minimis. And if any of this is happening from would-be buyers that are already stretched or people that are in that final phase of buying own to rent Airbnb properties. That is a recipe for a messy, messy ending. And I hope that's not what's happening here. I don't have enough information to know if that's what is happening. But if that's the case, that would be a really terrifying twist to the U.S. economy and to the housing market.
Yeah, I agree with you. We did have some retail earnings this week. Dick's Sporting Goods shares fell. They're about 24% down, slashed outlook on interesting like theft concerns. So we've talked about Target, we've talked about Walmart, and on their last couple of earnings calls talking about, how theft has now become a real drag on their earnings. Dick's Sporting Goods was the latest large-scale retailer that cited theft as being a significant drag on their performance. Net income for the 3-month period that was, over July 29th was $244 million, which compares to about $319 million over the same period last year. So not great news for them. Macy's saw revenue dip, both in-store and digital. What was interesting here is their bricks and mortar was down about 8%, and their digital sales were down 10%. There was some green shoot, I guess, on the retail earnings side with Lowe's. They were kind of a mixed green where, they beat Wall Street forecast, but they didn't see any huge trajectory there. Stocks were up 3.8%. Same store sales fell 1.6% in the quarter, but was less than what estimates were at 2.6%. So kind of a mixed green from Lowe's there as well.
Yeah, I think the two takeaways from this week's earnings, well, maybe there's three takeaways. Takeaway number one is I think there was more negative headlines than positive. We saw more losers than winners. Today, we saw Dollar Tree down 12%, Foot Locker down 30%, and Petco down 20%. Petco has been one of the real stalwarts, or at least it was during COVID, in terms of performance. And that has turned around and surprised to the downside in recent months. And that's more of that happened today. So takeaway number one is a lot more stocks in the retail segment were selling off rather than soaring this week. You could add Burlington to that list, which was down 8% today. Takeaway number two is this theft thing, even though we've been talking about it for 6 months, it now seems to be expanding both geographically and also to other types of retailers. In the beginning, we were talking about pharmacies. We were talking about CVS and Walgreens, or really high-end mag mile type places like a Rolex or a Gucci. And now we're talking about Dick's. And I got to tell you, if I'm a thief, Dick's is the last place I'm going. I can't think of 4 things I would need out of Dick's other than maybe a sleeve of golf balls. Setting that aside. And then the last thing I think we're seeing, and this comes out of the Macy's, is the consumer is tapped. They talked about rising delinquencies over the summer and a slowdown of spending from credit card charges. And those are the kinds of things we weren't seeing a year ago. We've been talking about problems in retail for a really long time. Oversupply of stores, older stock from B&C malls, and competition from e-commerce. These are new things that we haven't had to worry about in a long time. Credit issues and theft can only make you very nervous if you're a landlord right now.
Yeah, and I was in Chicago a few weeks ago and went into a Target there, and you mentioned Walgreens and CVS, having theft, and they were the first retailers where you saw large scale amount of items for their relative small footprint being put behind lock and key. Well, in this Target in Chicago, effectively 60% of the store was behind glass. So you want to get a bar of soap, you want to get some shampoo, you want to get a bath towel. You're basically having to wait on an attendant to come and unlock the gate for you to be able to get those things. And I'll tell you, if retailers don't realize, like, that changes the experience of the in-store shopping. Like, that almost, makes it where it's unbearable to go in as a shopper. When you're waiting on somebody to come in and unlock something to get you a simple toothbrush or a bar of soap, people are going to quit coming to the store altogether, and they're going to just order online. And maybe that's what some of these folks are realizing should be their strategy going forward, because that cost of theft is really dragging on them. But I'll tell you, it was really disheartening. Like, somebody that wants to go in and actually buy goods, your experience has been eroded to the point where you can't even go load up a cart. You're effectively waiting on somebody to come and put it in the cart for you, because everything's locked up.
that's going to only drive more e-commerce, right? If people are saying this is the way it's going to be, people will turn to those food delivery services to do this. They're not going to go in, and they'll continue to utilize Amazon and other competitors for that purpose. It's really a shame. I will take a quick detour. We talk about the negative shopping experience. This is kind of way out of left field, but my negative shopping experience this week was going to the grocery store. This has happened a lot, but I've never talked about it. And we were out of mustard and ketchup. And you go home and all you want to do is put, a big glob of mustard on your hot dog, but you got to peel that thing off to let the mustard flow. Like you can't just squeeze the thing, it comes off. You got to go in, and you could never get that little tab off. And all I could thinking was, are people really stealing mustard out of the canister at Ingles in South Carolina? Are they walking in with a hot dog and say, I'm not gonna pay for this mustard. I'm gonna take the mustard right now and pour it on my hot dog. And that's why they put these tabs on it. It's so irritating. They're so hard to get off.
Someone's going to email and let you know that's the seal for freshness.
Who's stealing ketchup? I mean, you can walk into McDonald's and get a lifetime supply in 2 handfuls, right? It's in the condiment section. They're giving it away. Anyway, 2 things I wanted to talk about before we close. I wanted to talk about interest rates. When I talked about the glass kind of half full at the open, one of the reasons is we had seen a leveling off of interest rates. The 10-year this week from last Thursday to this Thursday, down 7 basis points. We ended 817 at 430. This week it was down to 423 as of the close today. Listeners may remember we were up more than 50 basis points over the prior 2 months. So this is a change for the better. On the shorter end, things were up, but not terribly. The 2-year was up about 4 basis points. So that's what I think helped people gain a little bit more confidence. The other shoe that may drop this week, Fed Chair Jerome Powell talking tomorrow. He gives the famous Jackson Hole speech, which happens at the end of August every year. The Fed chairman does that. I believe it's been happening every year since the early 1980s. It's often a time for a Fed chair to offer up some castor oil. That was the case last year with Fed Chair Powell telling people that more rate hikes were coming, and it did lead to a sell-off. It'll be very interesting to see what his posture is on Friday and what that does to the market. So stay tuned for that and look out for some potential tweets from Lonnie or me or Haley tomorrow on what that's doing to spreads and treasury yields.
Okay, so let's kick off the commercial real estate segment this week with retail. We saw a big story. I know everybody's been talking about it, but I think the market will want your take on the mall loan that resolved with a $100 million loss.
Yes, this has been in the crosshairs for a long time. We put out a trading alert on this earlier this week. The property itself is the Crossgates Mall in the Albany, New York MSA. It backed a $242 million CMBS loan. The loan was spread across several CMBS deals. It was also part of CMBX 6. For those that are new listeners to this, CMBX 6 is an index that is heavily tilted towards retail, and speculators, investors have been taking long and short positions on the BBB minus portion of that index for many years. So this is a heavily watched asset. It is the biggest asset, I believe, or it was before the resolution behind CMBX. The resolution comes with a loss of almost $100 million. So out of a $242 million loan, a $98 million CMBS loss. The loss comes a little bit out of the blue. The loan was still outstanding. It was current, and the loss came via the loan being sold via note sale. The property itself is a 1.3 million square foot super regional mall. It was built in 1984, anchored by the likes of JCPenney, Regal Cinemas, Dick's, and Burlington. The property was valued at $470 million in 2012. The most recent value was $281 million. However, the gross liquidation proceeds totaled only $174 million, which means that the sale of the note, what they sold it for, was basically $100 million less than what this property was appraised for about a year ago. So not a good sign there. I'll come back with a couple of positive mall stories later, but this was probably the biggest negative for the week.
Yeah, and I think this comes on the heels of us having some pretty good stories around the mall sector over the last couple of months with people getting extensions or modifications or keeping things moving. This is a big number, however you slice it, and I think it's unfortunate, but at some level, and some point, we talk about this every month when the delinquency report comes out. You have a lot of this legacy mall stuff that's still just hanging out in purgatory. Now, this one here, I know you said based on it was current and whatever, and then this sells via note sale, but there's a lot of this stuff that's still just hanging out. And at least with this one, it has some resolution. We'll see what happens to the asset going forward.
Yeah, I'm going to give a little tease here for something I'm working on. I've been going through a lot of the special servicer notes for these legacy malls. This is a little curveball for Lonnie and Haley because we haven't talked about these two, but they're of a piece, and I wanted to just bring them up because I will be writing about them tomorrow, and we'll make this a freebie for our listener group for those that come into us. It probably won't be ready till Monday, but if you do email us, we'll send it to you. It covers about 5 or 6 or 7 different mall loans that have been in distress, for which I'm noticing a change of tenor in the special servicer notes to the better. And I'll pick 2 of them out right now, just for examples. One is the Glenbrook Square property, which is in Indiana. This particular property has been in and out of delinquency for a long time. And what I found this week with the special servicer notes is that the receiver who was put in a couple of years ago, and these are quotes from the special servicer, has been successful, quote unquote, with numerous tenants now renewing their leases at market rents with little or no tenant improvement allowances. The receiver, by the way, there is Spinoza Real Estate. And to me, that's a green shoot. We don't talk about really detailed green shoots with a lot of these malls very often, but I did see 5 or 6 of these this month, and I'm eager to get them out for people to see that not everything is negative. I'll talk about one more that came out as well. This was from the Cottonwood Mall in Albuquerque, New Mexico. They reported that the 2022 average sales for the collateral for year ending 2022 was just under $400 a square foot for inline tenants. Why is that important? Why is that a good metric? Researchers at banks and researchers at money managers have often called the dividing line between failure and success at a mall at somewhere between $300 and $350 a square foot for the inline tenants. When you get below $350, you get nervous. When you get below $300, often you're talking about dead mall walking. In the case of the Cottonwood, they're now saying that this is close to $400, which is well above viable. And that seems to be looking in the right direction. And more to come on this. I will try to get it in Haley's hands tomorrow. She is our distributor of information extraordinaire, in addition to being our podcast editor and tweeter extraordinaire as well. So if I can get this tomorrow, we'll make this a freebie for either tomorrow or Monday.
Yeah, so Manus, I know you said that was a curveball on the mall stuff, but I know we have a lot more retail to get into. And for those that are listening to this podcast, we actually recorded a guest podcast earlier this week with Bob Knackel of JLL. And it was really interesting hearing his take on retail in New York City. He was saying retail is definitely stabilized and on the uptick, and that he's seen a lot more interest in investment across the retail specter than what he's seen in some time. So I know we have a few more stories if you want to jump into those, but it was really interesting to hear his perspective on retail as someone that's been in that market for some time and obviously seen the ups and downs in the cycle.
Yeah, I think people are going to love that interview. I was telling Haley and Lonnie before that a one-hit wonder from the 1970s was the band The Knack, and their album was called Get the Knack. And I would urge you to get The Knack podcast next week when it drops, because there's a lot of great insights in there. He talked about how retail in New York City, especially in those corridors that house high-end stores, had really hit a wall starting in 2015. And recently that has been turned around, that we're starting to see the life, and nothing demonstrates that more than a story from The Real Deal. Rich Bachman, who does great coverage of the New York City tri-state area, in commercial real estate, somebody we mention a lot here. He noted that the Versace store at 747 Madison was sold for 135 million, which is an extraordinary price. This particular asset sold for 66 million in 2013. So really a more than 2x improvement in value over the last decade during a period where values have been falling considerably during that time. The buyer, interestingly, I had never seen this individual be a buyer of retail or even high-end retail at any point. James Dyson, who is the owner of the high-end vacuum cleaner seller distributor. Quick plug for the Dysons. I happen to love those vacuums. Greatest vacuums ever made. They pick up everything, always work, get into every nook and cranny and corner. Spectacular and light, easy to operate. He was the buyer. The sellers were Jeff Sutton and the Rubin brothers. Property does not back any CMBS debt, but it could be a useful comp for other street level retail. And one other comp before we get into other property types. This is from Burl Gilliard of the Minneapolis-St. Paul Star-Tribune. The Northtown Mall in Blaine, Minnesota, sold for 31 million. That's more of a glass half empty crabgrassy story. Only $48 a square foot for the 645,000 square foot property. The buyer was Fourth Dimension Properties. They also own the Burnsville Center in Burnsville, Minnesota. The seller was Washington Prime. They're kind of a discouraging comp.
I don't know anything about those buildings that you talked about, man. It's relative to my love for Dyson. I am a huge Dyson fan like you. I like to vacuum generally. Cleanliness is next to godliness. It's kind of one of my things. Love the lines, got to design it, make it look good. But the Dyson vacuum, unbeatable. I've had the Shark. I've had several others. It's unbeatable. The fanless or bladeless fans that they have, incredible. Blow dryers, unbeatable. The guy is a genius. Like the stuff that now I will say, I did see something recently where it's like the headphones with a mask or something. Like I saw some people wearing that. Probably not a huge fan of that one. Haven't tried it, but the other stuff, I'm all in.
I'm getting this vibe right now of Lonnie channeling Robin Williams and Mrs. Doubtfire with Aerosmith. His dude is like a lady playing in the background. He's just rocking out and using that Dyson to clean the rug. That's kind of the image I'm getting right now.
That's pretty close. It's actually Survivor, like the Rocky song, "Eye of the Tiger," or one of the theme songs from the Rocky movie that I'm playing in the background as I'm like whisking the vacuum back and forth. And so I think I'm on my second or third Dyson at this point. And I always go with the animal. I don't even have an animal, but I go with the animal edition because it just gives you a little extra oomph.
Lonnie, you're an animal.
Okay, so let's talk about multifamily. This was another property sector that we had a lot of big news for this week.
Yes, more good than bad, a lot more good than bad, and an awful lot of comps that we're going to run through here. One bad story, plenty of good. We put out a trading alert earlier this week. It got picked up by The Real Deal in San Francisco and others, but we broke this early in the week. The NEMA San Francisco loan has been sent to special servicing. This is a $384 million loan backed by about 750 apartments. This news came via August remittance data. The loan has had DSCR levels below 1.0x since 2020. Commercial Real Estate Direct, our sister company, wrote late last month that the loan was at risk. It is now facing imminent default, and the borrower has stated in writing can no longer cover monthly debt service. There are $23 million in reserves, which should help this loan stay current for a while. But DSCR in 2022 was 0.71x. The owners have been giving 1 month free rent concessions to lure tenants. And in a nearby retail space, Whole Foods back in April announced it would be closing its store due to theft and quality of life issues. So that's one we're watching. It backs a single asset deal. There's also slices of the loan in a couple different 2019 U.S. conduit deals.
Yeah, I mean, I think that one's interesting. Even with the large reserves, may not make it. And I think, there's been a lot of stuff. We've put out some stuff recently around multifamily generally having some maybe larger cracks than what people realize just because it's being overshadowed from office and other distress. But I think we're going to start seeing more of these stories across the U.S. and in particularly markets where there's quality of life issues.
So I'm going to roll through 3 green shoots in rapid succession. The first one from Nuala Hafner of Off Plan Property Exchange. A lot of multi-syllable words that I'm going to have to get out here. Ponta Gadea has acquired a luxury apartment tower in Chicago's West Loop. That's the headline. The apartment complex is at 727 West Madison in Chicago. Sale price $232 million. The report says that it's the highest sales price for Chicago apartment in 2023. The comp there, $472K per apartment for the nearly 500 unit complex. The buyer again, Ponta Gadea, which is a family office of Zara founder Amanceo Ortega. I can't believe I said Ponta Gadea twice, now 3 times. Another green shoot. This is from Real Estate Business Online. Bell Partners has purchased Vintage Jones Franklin, a newly built 277 unit complex in Raleigh. The sales price was not disclosed, but rumors have it at about $290K per unit. This is situated at the intersection of I-440 and US Highway 1 between Raleigh and Cary. Lastly, this comes from the Orlando Business Journal. Alta Cypress Apartments in Longwood have been sold for $90 million. The sale price equates to about $263K per apartment. It's a 342 unit property. The property was only recently completed by Wood Partners. The buyer is said to be affiliated with Journey Capital Real Estate Partners. The property does not back any CMBS debt.
Yeah, it's really interesting, man. It's like I'm showing my age here in the marketplace because I remember when you could buy suburban multifamily, high-end Class A stuff for less than $150K a door. And now, this stuff is trading for north of $250 per unit. It's really just interesting to see, even in this part of the cycle where we're at. A couple of comments. It's good to see Bell Partners with the acquisition in North Carolina. I know there's been some discussion around some of those markets starting to slow down. Bell had been active for some time, and so $80 million for that deal. New construction built in 22. I think that's probably a good sign. I would assume that means they've hit some lease-up hurdles and other things to make that property marketable at that price point. And then the Chicago deal, as you mentioned, this price, $232 million, set the new record for sales this year, and pretty wide margin there. If you look at the previous high watermark for multifamily transaction in Chicago in 23, it was at $173 million. That took place back in June. So you're looking at a pretty large delta there. And I think you did really great on the enunciation, the pronunciation of the really difficult word and naming conventions there. Though when you see those, I always want to know what's the backstory. Like, why are you naming something that's so difficult to pronounce? But I'm sure there's some really cool, either mythical or some sort of story behind it that we just don't know.
Well, I once said publicly that I'm a man of little words, and my wife tried to correct me and said I'm a person of few words. And people on the podcast will know that I'm not a person of few words. I say a lot of words, but I am better off with little words than big words. 1 syllables, I really ace. 2 syllables are okay. 3, I start getting really out of my lane. So yes, we'll have to see how that sounds on the pod. I did have 1 crab in the multifamily. It's not a terrible crab. This is in Arlington, Virginia. This is from the Washington Business Journal. The Avalon Columbia Pike apartments in that town have sold for $105 million. This equates to about $390K per apartment for the 269 unit property. The property will be renamed Jasper Columbia Pike. It was acquired in by Avalon Bay in 2016. The buyer was Penzance. Why is this kind of crabby? Well, Avalon Bay acquired the property for $102 million in 2016. So very little appreciation over 7 years of holding this for what is probably a fairly nice apartment. Avalon Bay doesn't really traffic in low-end properties. But my takeaway for all these stories, if there's one lesson to be learned here, is even though we've talked frequently about crabgrass growing in the multifamily space among the syndicators, among people who would take floating rate debt, that capital availability was becoming constrained. Here in 1 week, we have 4 sales of $80 million or up, with a peak of more than 200 million happening. So it does show that there is some activity there. It's not zero. People can get financing, and that's a good thing for the market. It's not 2021, but it's not 2009 either.
Especially at those price points, there's a capital stack associated with that includes some financing on those deals. So I think it shows that for really nice assets in markets where there's upside, or the properties are performing even through this downturn and the operators have been able to manage expenses, there's still buyers and sellers that can get deals done. And so multifamily is an interesting construct in the sense that, it always has a relative risk that's less than some of the other asset classes, just because of the nature of people needing a place to live. Now you could talk about, have we built too many Class A's? There's a bunch of new units coming online in the major metropolitan areas and so forth. But to your point, Manus, even the bad news for multifamily to date, slower rent growth, higher expenses, et cetera, haven't completely derailed the sector. And I think that for every one negative that we're going to see with some of these syndicators and being over leveraged or whatever, there's probably a multiple of that on the good side. And hopefully for them, I think this is one sector where interest rates really could impact a comeback there. If interest rates come back down, there's a lot of these properties that are probably primed for sale over the next, couple of years, because in some markets, they've still seen significant rent growth from when these properties were acquired, maybe even 2 or 3 years ago.
Okay, let's talk about the office market. We have a lot of stories there.
Yes, a lot, but not as many as usual, which is kind of a good thing. I'll start with something that we sent out earlier today. If you saw it on Twitter, we're making it available to people. I thought this was another green shoot of sorts. It's a little bit outside of commercial real estate per se, but it does have implications. The story comes from Commercial Observer. It happened earlier this week. They reported that Fortress Investments had acquired about $1 billion worth of office loans from Capital One. The collateral was said to be made up of New York office properties. The pricing was not revealed, but a Washington Business Journal piece noted that Fortress has been usually buying loans at near par, for what that's worth, right? We don't know. Near par is at 98, 96, 94. We don't know. But I think it does have positive implications for both the market and for the bank. For the market, the implication is that Fortress is coming in. They're smart guys. They've been players in real estate for a long time. They see value in buying New York City office debt. Whether they're buying it to own the properties or buying it for the cash flow, we don't know. But regardless of that, it's a vote of confidence. For the banks, the implication is that they can move these assets and they can move them in big quantities. This is a big sale here. And this should be encouraging to those that are thinking, we would like to tweak our balance sheet right now to reduce our office exposure, to improve our liquidity, to move the narrative away from how much office we have or how close we are to that 300% limit of risk-based capital that the regulators want you to stay below. All of that becomes much more attainable once you see this type of sale. And I think that's a great thing. Our piece out there is loaded with commentary about how much CRE debt Capital One had at the end of Q2, how it was performing. We have oodles of this kind of information in our products. Matt Anderson is our bank guru. He helped us put this together. And if this whets your appetite for seeing more bank data, who has big CRE exposure, who has seen big upticks in CRE exposure or CRE delinquencies over the last 6 months or 3 years, he has this data up and down. And if you're interested in that type of thing, we're happy to put you in touch with him.
Yeah, I agree with you, Manus. I think this is a really great sign for the market. I think this is how the market's designed to work. This is what you want to see in a free market system, where you have somebody that feels they have too much exposure. There's a buyer out there at a price, and in this case, it appears that maybe it's near par. And to your point, Fortress, these guys know what they're doing. They must have a strategy, or there's some sort of upside that they see either in the cash flow or in just owning the buildings in that location. And $1 billion is nothing to sneeze at. I mean, this is a sizable transaction. I think it bodes well for the market at large. I think now that kind of this domino's fallen, I wouldn't be shocked if we see some other announcements over the coming weeks of similar types of situations where certain lenders or banks feel like they need to, lessen their exposure to the office sector. And this maybe shows that there's a marketplace for that. So I think all in all, really great. I'd love to see the details as they come out and we can kind of get a better feel for what kind of haircut, if any, of these things took. We know the PacWest portfolio, the new construction portfolio that transacted a few months ago was about an 8% haircut. So it'd be really great to see what happens here on the office sector. And just to echo for those listening, our bank data is really robust. And we talk a lot on the podcast about CRE, and we give some really deep dive stuff around the CRE operations and so forth. But to Manus's point, our bank data is really great as well. And we've actually develop some really bite-sized, easy to use and digest outputs based on the current banking sector crisis. So we'd love to get a chance to talk with you if there's any interest in what we could do for you, maybe on your bank needs.
Well, I'll have to say that if we're going to entertain these types of calls, I want Matt Anderson at my right hand. I am a tourist in the bank data space. I'll be the first to admit it. I do look at it and I read the news and so forth. But from my perspective, from where I sit, I definitely want him on the steering wheel for that. He's been following this stuff for decades. Few other stories. I'll start with a positive one from the Real Deal. This comes from outside of Pennsylvania. David Werner Real Estate has acquired a life science and office property from Pfizer. They paid $180 million for this property, which is in Collegeville, PA. Pfizer had owned the property for a long time since it had acquired Wyeth in 2009. Pfizer was the seller. The property is currently leased to Dow Chemical and Wyeth. And I think Wyeth extended the lease as part of this sale. So bona fide green shoot there. We do have a couple of crabgrassy stories in the tenant side of things. We put out a TreppWire news alert a few hours ago in St. Louis at the B of A Tower, where B of A has already downsized, where the fourth largest tenant has already downsized there, and where the loan has already missed its maturity date with the loan going to the special servicer. Today, we found out the second largest tenant, Treetop Foods, has announced it will not renew its lease next year. It has about 18% of the square footage there. And in addition to that, the borrower told the special servicer this month that they will no longer fund shortfalls for the property going forward. So that's a negative story for us. Out on Long Island, part of the Signature office portfolio has gone dark. There's a 290,000 square foot office in Hauppauge, New York, not too far from where I grew up. Allstate was the top tenant there with 31% of the space. They have gone dark at that space. Their lease ends in 2026. And in Chicago at the Illinois Center, we got word that the property there, which backs a $256 million CMBS loan, has reported that the U.S. Department of Health and Human Services will vacate its space when the lease ends in November. This is a real tough pill to swallow for that property. The loan is backed by offices at 111 East Wacker and 233 North Michigan. Occupancy was already down to 56% in 2021. It rebounded to 63% last year, but this losing of 170,000 square feet, 15% of the space at the Michigan Avenue address will weigh on that property, which is a source of concern for that market.
Yeah, it's not great to finish up the office sector with some crabgrass, but I think those stories definitely qualify. The St. Louis stuff is interesting. I was actually looking at that market the other day, and the issuance has effectively been zero there for some time. Like, that's a market that's just really had some fundamental challenges predating even the work from home, post-COVID. It's been a struggle for offices to maintain occupancy and perform, and there's not been a lot of issuance there. Maybe something on the DC stuff. I know Haley sent around, I think it was Market Pulse or Market Watch had an article this week that talked about the federal government making some pleas to get people back into the office. So I know we had spent some time over the last month or so talking about how that market in particular had been decimated because the government workers were remote. So maybe there's some faint pulse there of maybe getting some of those workers back into the office. So we'll see what happens, but not great news. I will take the one green shoot though. It's a nice green shoot for the office sector. And at least we have some good news to talk about this week.
That DC office stuff, it's not just DC that will benefit. We have, as our last story said, Department of HHS is in Chicago. Almost every city has some GSA exposure. And if we can get all those people back to work, it'll help the landlords, it'll help the property values, it'll help the office ecosystems, to be sure. But I have to say, as a guy who more than once spent 3 hours in a New York City DMV, I'm not holding my breath waiting for, people coming back to the office and being there 9 to 5, 5 days a week in the public sector. I think that's going to be a slog, and I think that some people will, but I don't think it's going to lead to this enormous reversal of what we saw in 2020. I think it's going to be a real tooth and nail fight. Some people will retire, some people will move to the private sector. I don't think that this is going to be cork popping moment for landlords.
I would agree with you. I think in the survey that we mentioned in the previous pod highlighted that. I mean, I don't think any of the government occupied offices had higher than 50% utilization rate. So even if it's a dramatic uptick, it's still not going to move the needle. But at least they're talking about it.
We have one other green shoot this week, and it's in the industrial sector.
Yes, we're throwing a little love to the couple of people that have emailed us over the last 3 months saying that we do give industrial a little bit of the short stick, so to speak. Every week, we don't talk about it so much. A lot of that has to do with the strength of the market. But when we do see stuff that we can throw out there as comps, we will try to do so. This comes from, again, Nuala Hafner of Off Plan Property Exchange. She gets the double header this week in terms of 2 mentions. CIP Real Estate has acquired Clipper Court Commerce Center, which is in Fremont, CA. A sales price $103 million. The property is 350,000 square feet, and it consists of small and mid-bay industrial, along with some flex office. Property is 89% leased, mostly to manufacturing and some technology tenants. Among them, BASF Corp, Hyundai, among the top tenants there. The buyer is going to invest $5 million in improvements, and I didn't do the math here, or if I did, I didn't put it out there, but it does represent a comp that I guess looks to be $300 a square foot. Am I doing the math right?
Yeah, I think this is definitely a green shoot based on the tenant roster that you mentioned. Reads to me that they think there's some upward mobility in the rents there when those leases come up for renewal. $5 million to put in for capital improvements to try to enhance the status is a good sign. So all in all, great. Occupancy is probably a little lower than I would have expected given where it's at. But overall, great story, and glad that we're able to get a little industrial talk in on the pod this week.
So I didn't even have to take my socks off to do that in my head. And it was $294 a square foot. So that's a pretty good comp, I have to say. It wasn't that long ago that we were seeing industrial sell for 80, 90, 100, 110. Here we got $300 a square foot for a property where the owner is going to pump in another $5 million and is not 100% occupied. I think that's terrific.
And finally, we saw Moody's a few weeks ago downgrade the ratings of 10 banks, and they added a negative outlook or a potential future downgrade for other banks as well. And this week, our team dug into some of the risk metrics associated with this. Lonnie, can you walk us through it?
We looked at the underpinnings for the downgrades, especially, as the downgrades are likely going to make borrowing more expensive for the banks, which just further deteriorates their bottom line. So in this analysis, we highlight metrics concerning the reasons for the downgrade using the FRY9C data or the consolidated financial statements for the bank holding companies. And this is data available in our Bank Navigator product. We look at metrics for CRE concentration, capitalization, profitability, asset quality, and liquidity. And then for consistency purposes, the metrics referred to in the analysis are updated as of Q2 of 2023. So if you want to get a copy of that, send us an email at podcast@trepp.com. There's a lot of really good, interesting nuggets. Obviously, Gave you a few things to look at here based on what we covered. But if you want to see exactly what the results are and what the data looks like, we're happy to share that with the full report.
And as a reminder, next week or this week, if you're listening after the Thursday or Friday release, we are hosting 2 webinars. One is for clients, and we'll look at hidden distress in floating rate debt. And the other one is our Market Pulse webinar. So if you're interested in either of these, send us an email and we'll get you the registration links. And turning to shout outs, Marcelo C said he really liked the most recent episode. Office comps at the end in particular were solid, so we'll give you more of those. Matt Z reached out about our Market Pulse webinar. Our own Tyler T let us know that Eric B is a huge podcast fan and convinced some of his friends to listen as well. He also said that our marketing played a big role in signing up for Trepp. So I think, Eric, I might need you to get me a letter of recommendation or something like that. Mark C said he's a regular listener and finds the podcast very insightful. It's a great way for a newbie private investor like me to keep a pulse on the market trends. Paul L had some feedback for some of the comments we made recently. He said we often hear that traditional CRE lenders have shut down. Competition is minimal other than possibly agency, and he disagrees with that statement. So he gave us some feedback and talked about what he's seeing. On Twitter, we had a bunch of engagement this week. Matthew W said, great pod this week. Yes, keep the loan details coming. Important market data. Brett C, a big shout out to the TreppWire Podcast. Thanks to their insightful episodes, I've gained a deeper understanding of the ever-evolving world of CRE. And he's a student in CRE, so we're glad we can make an impact there. Connor S said he started listening to the podcast and it's helpful to hear about mindsets in other industries. Survive to 25 seems to be a big thing in CRE right now. And he actually found out about our pod from our Pete G, who says we have a fantastic team and this is a must listen.
I had a couple I wanted to throw in there too, Haley, and I think Manus had a few as well. Had a podcast listener reach out via LinkedIn a week or so ago. Young, just recent graduate looking for some guidance in the CRE space and how to break into it. So set up a quick call. Brennan C, great meeting you. Thanks for listening to the podcast and happy to help you in your CRE endeavors. And then we also had a listener reach out on Twitter, schedule a demo with one of our team. So Wesley F, thanks for listening and looking forward to getting you on board here with the Trepp product suite.
And I had a gent that I go back with 20 years. He didn't want to be called out by either name or initial, but I have to thank him for, he twisted my arm to come out for a couple of beers last night, and we got to catch up on CRE and CMBS. So thank you for those beers. And tomorrow I get to taste some really great Southern barbecue, courtesy of one of our listeners. We're going to meet up for lunch in Greenville, South Carolina. And my mouth is watering already. I can't wait.
Hey, Manus, for our slice of life this week, did you see the news? Shohei Ohtani, the torn ulnar collateral ligament in the elbow. Looks like he's going to be shelved, probably second Tommy John surgery. Coming on the heels of the Angels not trading him at the deadline, trying to make a push with him. His impending free agency, where he was probably going to cash in about $600 million contract. What do you think happens to his contract? What do you think happens to the trajectory of his career? Just devastating news.
Devastating news. I hate to see this, whether, I'm a fan or a foe of the team or the player or whatever. You hate to see great players, especially him. He might be the greatest baseball player ever between the pitching and the hitting, and it's sad. I do think he's still going to get that big contract. I think people are going to expect him to come back, and something tells me they're going to say, maybe somebody on the likes of Steve Cohen will say, we'll pay you $25 million next year with a 4-year option for $500 million to kick in the following year when you're ready. And it'll only be a player option. But, I'd love to see him on the East Coast, especially with the Mets, and certainly not with the Braves or the Phillies. We'd love to see that happen. He's a thrill to watch. I just wish he was on the East Coast.
Yeah, it's tough with the time difference out there on the West Coast. It looks like the Dodgers or the Giants are probably the leading candidates to land him, but it would be really great to see him in a big city like New York with all that he's capable of. Really once in a generation type of player for sure.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.